Rule-based projections let you automate your forecast using your historical data and simple business logic. Instead of entering fixed amounts manually, you define rules that tell Cashflow Frog what past data to use and how to calculate future amounts. Most customers use this in three main ways. You can project based on a rolling average, like the last 3 or 6 months. You can reuse past values, like last month or the same month last year, with optional growth. And you can tie expenses to income, for example, calculating materials or commissions as a percentage of sales. Behind the scenes, every rule is built from a few simple components. A look-back period, which defines the time period relative to the projected date. Filters, to select the data by account, customer, vendor, or any dimension. And an amount formula, whether to use a sum or average, and apply percentages. Let's walk through a few examples. First, a rolling average. Set the look-back period and the duration to the last 6 months. Choose your expense account and use the average. This keeps your forecast aligned with recent activity. Second, same month last year with growth. Look back 12 months. Select a 1-month duration and apply an increase, for example, plus 10%. This works great for seasonal planning. Third, percentage of income. Look back 2 months. Select a 1-month duration, filter by your income accounts, use the sum, and apply a percentage, let's say 32%. Note that I added a minus sign, since we're projecting an expense based on income, so the amount needs to be reversed. This automatically projects costs like materials or commissions as your revenue changes. From now on, your forecast is no longer static. Cashflow Frog recalculates everything automatically based on your rules, so your forecast stays accurate and always up to date.